issue accounts. Now, at the point of payment, at the point in year 5, if the employees are able to perform up to expectation, that means that they will be entitled to this share to be issued. In that case, we're going to debit shares to be issued account and now credit our ordinary share capital to recognize the share itself at fair value. So that is the entry required under share payment transaction. But those employee that does not qualify means that we are going to reverse these entries. This entry we have initially passed will be reversed. So that is the nil of the account. So the date an agreement is made under share payments, which is IFRS 2, that date is referred to as the granting date, but the date of payment, that is after the agreement has lapsed, that is referred to as what? The vesting date. The major entry, that is the real entry, should be passed at the vesting date. Why the recognition should start from the granting date. That is the date of recognition. Now, before an entity can start discussing about IFRS, there are some factors that needs to be considered. Number one is that there needs to be an initial evaluation. The company needs to know that if we are converting to IFRS, what are the pros and cons. Number one thing that needs to be discussed is there knowledge of IFRS within the entity? That is, the staffs of the company, are they conversant with what IFRS is all about? That question needs to be answered. Another thing is that, are there any agreements such as that are dependent on local GAAP? That is there any bank covenant or any contract at all that are solely dependent on local GAAP? All these questions needs to be answered. Then the third one is, will there be a need to change the information system? Definitely there is going to be a need. With IFRS, most of the information system may likely be changed in line with the new standard. Accounting manuals may need to be rewritten again to comply with IFRS. Then which IFRS will affect the entity? It is not all the IFRS that affect some entity. For example, now business combination is only for those that are into group. If a company is only a single entity, no need of doing business combination. So all the IFRS are not applicable to some companies, but some companies only pick those ones that are applicable to them. But whichever that is applicable to a company, they must be applied in full. Then, is this an opportunity to improve the accounting system? Obviously, it's going to be yes, because IFRS is preaching comparability. That is, there should be a comparability worldwide. That is, the account prepared in Nigeria, we should be able to compare without prepared in UK, without any interpreter. Now, once this initial evaluation has been done, then we can now request for assistance by looking at the following. So, after the initial evaluation, a company may need to engage an expert that will conduct some training for staff, which is required. Assistance of an expert may be required to conduct training for staffs on IFRS. Then inform key stakeholder on the impact. That is, all public listed company, that is PLC, they need to brief some shareholders, probably make a newspaper briefing that the company is now adopting a new standard. That information must also goes out to the analysts, bankers, creditors, and all the employees. They must be aware of the new standard that is being adopted by an entity. Then they must also produce a plan. This is like a conversion plan that will show the timetable and how the conversion itself will be conducted. They must produce this plan. Then they will also need to investigate if there is need to change the computer software to the one that is conversant with IFRS. A company may also need to consider all this too. That is changing of computer software. And the final note is establish if the current system can easily be changed and not what the alternative will be, particularly the IT cost. That is, the cost implications of converting to IFRS should be analyzed at this stage. Now, for us to convert to IFRS, what are the benefits? Number one benefit is that it will enhance comparability. That is, Nigerian will be able to compare it. The Nigerian company will be able to compare its account to any other company in the world. That is comparability. Another important of this IFRS is that we can easily have access to foreign funds. That is, we can easily have access to foreign loans since our accounts will be very easy to understand by them. There is full disclosure, so they have all what they required in the accounts. Then it may also give us foreign investment opportunity. Then another thing is that for shareholder, they will have a full glimpse of what is happening in the entity. That is the full disclosures. So these are the importance of IFRS. Now, what we need to understand again is the roadmap to IFRS. In 2010, a committee was set up in Nigeria to prepare the roadmap to IFRS. And the report of this committee was submitted in September 2012. And the committee came out with the following report. That is, the conversion of Nigerian companies to IFRS will be in phases. That is, some companies are under the phase 1, some are under the phase 2, and the final phase is the phase 3. For those under the phase 1, they are the listed and significant public entity. These are the entity whose shares are quoted in stock exchange, e.g. PLC and all those companies, insurance companies who are quoted on stock exchange. They are under the phase 1. Government business entity like NNPC, PHCN, they are under the phase 1. Unquoted entity like private banks and insurance company, all these companies are under the phase 1. For this phase 1, their transition date is 2012. And the reporting date is what? Is 2012. Transition date is 2011. That is the previous date, while the reporting date is what? Is 2012. They must start the processing from 2011 and end in 2012. For example, now, if these companies are preparing their account to 2012, their transition date must be the previous year, 2011. That is the year they we prepare their opening balances in line with IFRS. That is what is referred to as transition date. So they are expected to convert in 2012. So all these companies now, they prepare their account of 2012 in line with international financial reporting standard. Now for phase 2, the following are the companies under phase 2. Number 1 is all public interest entities, PIEs. They are under phase 2. This they comprise of any companies whose turnover is above 500 million naira. Any company whose turnover is above 500 million naira, they are under the phase 2. That is, they are all these medium scale enterprise. They are under phase 2. If turnover is above 500 million naira, that means that the company is under what? Phase 2. Then all unquoted or private entity which have the significant public interest because of their nature and size. The size is known by the turnover, that is above 500 million naira. The number of employees or their companies which require wide range of stakeholders. The main thing is that they must have turnover of that is in excess of 500 million naira or net assets that is above 200 million naira. So those companies, they are under the phase 2. That is a not quoted on this, but whose turnover exceed what? 500 million naira. Examples of this, and also all NGOs, they are under phase 2. Their transitioning date is 2012, while their reporting date is 2013 for all these companies under phase 2. Now, if your company is not under phase 1, that is, it's not PLC, and it's not also under phase 2, its turnover is below 500 million naira, then definitely the company must be under phase 3. Phase 3 is for those whose turnover is less than 500 million naira. In fact, all other companies not covered under phase 1 and phase 2, all of them are covered under phase 3. Examples of these companies are small and medium enterprise, that is, companies whose turnover is less than 500 million naira. Those companies, their transitioning date is 2013, while their reporting date is 2014. For all these companies whose turnover is less than 500 million naira. Now, let's look at the disclosure that is required under IFRS. Like I said, before you can prepare IFRS accounts, you must make use of audited accounts. Now, the first thing that is required is that reconciliation of equity reported under previous GAAP. This has already been previously explained. That is, at the financial reporting date, financial position, also at the end, you must reconcile your opening equity to the closing equity to arrive at the IFRS equity. For that will be used in the conversion. The next thing is this: reconciliation of total comprehensive income for the last annual period reported under the previous GAAP to total comprehensive income under IFRS. You must reconcile the income of the Nigerian GAAP to that of the income of the IFRS for the same period. The first thing is that explanation of material adjustment that was made in adopting IFRS for the first time. Whenever you are adopting material IFRS for the first time, any material adjustment that is made to your record should be what? Disclosed. You must make a full disclosure. Then, the last thing is, if errors in previous GAAP financial statement were discovered in the course of transition to IFRS, then this must be separately disclosed. All error discovered in GAAP must be disclosed fully when converted to IFRS. Now, the next thing is, if the entity recognize or reverse any impairment losses in preparing opening financial statements, this must be disclosed. Whenever there is a reverse in any impairment losses is when the recoverable amount is less than the carrying value. So whenever any impairment loss is discovered, then they must be disclosed. That is in the period of transition. Now, let's take down this question. An entity has at 31st of December, an entity has a 31st December accounting year end and intend to prepare its its financial statement to comply with IFRS for the first time in the year 31st December 2008. The entity reports 1 year of comparative information. Now, you are required to analyze the transition date and the conversion date with simple diagram. This is how it goes. Conversion date is 2008, but transitioning date is 1st of January 2007. That means that's the period where the comparative account will be prepared. The comparative account will be prepared in 2007, and this is the transitioning date which goes to the conversion date, which is 2008. For this company, now the conversion date 2008, while transitioning date is the 1st of January 2007. It is in 2007 that they are going to prepare a comparative IFRS account, which will be in line with what 2008 conversion year. Now, let's take down these questions too. An entity is a first-time adopter of IFRS. It has previously reported under local generally acceptable accounting practice, local GAAP. Then, the entity has identified the following items as remaining a useful life treatment items as requiring a different treatment in the opening IFRS statement of financial position. The first thing is this: an intangible asset acquired 2 years ago, which was not recognized as an asset. Now, this is the first question. The second one is developmental costs recognized under local GAAP in the opening statement of financial position do not meet recognition criteria. When you are converting this into IFRS now, this intangible asset that was acquired but not recognized under IFRS, this intangible asset should be recognized. That's the solution. It should be what? Recognized. But meanwhile, this developmental cost that does not meet the criteria for recognition, this such developmental cost should be derecognized. It should not be recognized. This should be recognized. Why this should not be what? Derecognized. Now this is the solution. Under local GAAP, but which means IFRS recognition criteria, the asset should be what? Recognized in the opening IFRS statement of financial position. Then developmental cost should be removed from the opening IFRS of financial position. That is because it does not meet the recognition criteria. It is worthy for us to also note the regulatory body. That is, in Nigeria, prior to 2010, we have our local statement of accounting standard, which is being issued by Nigeria Accounting Standard Board. Immediately Nigeria start using IFRS, this NASB was dissolved and the new name is Financial Reporting Councils of Nigeria, which receive instruction directly from IASB. IASB issued IFRS. Nigerian FRSN, they receive instruction from them, and they also receive guidelines on how this IFRS should be applied in Nigeria. So FRSN is set up by the federal government of Nigeria to receive instructions briefly from International Accounting Standard Board of United Kingdom. That is, they receive some basic principles and information or guideline on how the standards should be adopted. Now, IFRS 1 is for only 1 year. That is the year the company is converting to IFRS. After the year of conversion, IFRS 1 is no more again. That is, a company will stop using IFRS 1 after its conversion period. It is only applicable in the year of conversion only.